Back in 2019, the government unveiled the National Infrastructure Pipeline, the NIP program, encompassing investment across the infrastructure spectrum with a massive investment outlay of 111 lakh crores over FY20 to FY25. Now, unfortunately, the global pandemic-led stress, both on execution and funding side, delayed many of these programs. While this may be a forced slowdown, the good thing is that today, barring the third wave of COVID-19 and its impact, India's infrastructure story is even more promising in the light of government focus, easing of ground-level issues, government's policies, increase in government revenue, and a conducive funding environment. In fact, part of this is already visible in the government ordering and a strong pickup in execution reported by the companies that are operating in the Indian infrastructure space. This could also be supported by the fact that post the second wave of COVID-19, the central and state capex during the year-to-date period of FY22 is already estimated to be higher by 40% on a year-on-year basis. NIP is a huge source of opportunity, and the good thing is that a large pipeline is still up for bidding and execution where Indian engineering and construction companies have a larger role to play. Of the projects identified under the NIP, 40% are already in the implementation stage. Many projects were delayed and bids were postponed due to COVID, which are now expected to be awarded. Another good thing is that the government continues to be the major driver, accounting for about 80% of the infrastructure investment planned under the NIP program. The central government would lead in the infrastructure investments, with its share increasing from 30% in FY20 to 39% under NIP. State government share would decline meanwhile from 46% in FY20 to 40% under NIP. The share of private sector is expected to come down marginally as well, from 24% in FY20 to about 21% under the NIP program. The increasing role of central government means a faster execution and lower stress on the balance sheet. Most of these are central government flagship programs, the likes of National Solar Mission, Smart City Mission, Housing for All, Bharatmala, Namami Gange, railways electrification and station redevelopment, major port connectivity, and even greenfield development of airports and other urban infrastructure like sanitation, etc. are relatively stable and time-bound programs which typically do not suffer funding and other execution-related issues. While most segments have seen a large allocation under the NIP, considering the COVID-led challenge, projects in the railways and construction of roads have not only got the highest allocation, but also continue to witness good uptick in execution. If we talk about execution-related challenges in these two segments, they've been relatively low given the government's priority as well as policies. During the lockdown in the first and second wave, restrictions on these segments, if you remember, were limited and were lifted immediately. From April to October 2021, the Ministry of Railways utilized close to 56% of the budgetary allocation in FY22 as against 52% in the last fiscal. In this period, it also spent about 60,400 odd crores, which is up 64% compared to last fiscal. Similarly, despite hiccups, the government constructed roads at the pace of 37 kilometers per day during last fiscal year and intends to close the current fiscal year at 40 kilometers per day. The road sector is likely to rebound with higher budgetary allocation this year in the union budget, with an expectation of close to 30 to 35% increase in allocation, with the aim of constructing at the pace of 50 kilometers a day in FY23. The way ahead for transportation and construction of roads will continue to remain buoyant in the light of higher allocation and increasing execution. Our high conviction ideas, KNR Constructions, PNC Infratech, HG Infra and NCC continue to do well amid difficult times. These companies have a strong execution track record, lower leverage with debt to equity close to or less than 1x, a strong balance sheet and cash flows, and have sailed through several industry down cycles in the past. Their robust business model and focus on balance sheets have helped them reduce risk and create value for shareholders. Now, these companies, we believe, should continue to benefit and grab the opportunity that infrastructure offers in the country. Moreover, the companies have seen significant improvement in execution, and their cash conversion cycle has improved considerably in the last 2 quarters. With this and strong order book, the revenue visibility of these companies is much higher currently, and earnings growth should be better in the months to come. Now, our conviction stocks are trading at around 10 to 11x FY23 projected earnings, and if you look at the valuations, which are at the lower end of the long-term historical average multiples. With strong earnings growth and robust visibility, we expect these stocks to continue doing well and thus reward shareholders.